So let's talk a little bit about the Ag Economy Barometer. It's a phone survey of 400 U.S. agriculture producers. Monday, I actually spent quite a bit of time summarizing the data that's going to be released the first Tuesday of February. That's double secret information until the first Tuesday of February. And so I'm going to be talking about the December numbers, but nevertheless, it's very similar to the more recent numbers. But the December is the latest survey that's published, and we do try to survey full-time producers. That's why we have a gross revenue of $500,000 there. There's 90% of all farms in the U.S. It's not that high in Indiana or the Corn Belt, but 90% of all farms in the U.S. Have a gross revenue less than $500,000. So that's why we're targeting greater than $500,000, so we get full-time farms. So that's one of the characteristics of the participants. And then obviously it's a phone survey. We do not call the same people every single month, but we try to keep the characteristics of those that we survey the same. So it's always 2/3 corn, soybean, and wheat producers. And so with that, let's get started about some of the results. One of the more interesting questions to summarize is the open-ended question at the end of the survey. And so we just have people share their thoughts on what's going on. Sometimes this cloud is one or two words. Like, for example, during COVID-19 was the dominant thought on people's mind. Now there's just a lot of things on people's mind, and that's really impacting the sentiment. The sentiment right now, even though we're coming off of two really strong net return years, 21 and 22 were some of the better years we've seen in production agriculture in general since 2010, 2011, and 2012. Even though that's the case, there's still a lot of uncertainty out there about where things might be heading. And I hear some cash rent bids in Illinois and some other places that are really high. And so you start worrying about costs are really high. What happens if prices come down and costs remain high? And so that's definitely on people's minds. And I'll show you a slide related to that. And so that's how I would summarize that. Interest is becoming more important. Obviously, I'll talk about that during this presentation. The policy of politics is not so much the Farm Bill. It's more related to energy policy and Federal Reserve policy. If you look at those comments, and then of course energy is up there also. But there's just a lot of stuff that's up there, and a lot of stuff that people are worried about. And so with that, the index has a base of 100, and that was simply the first 6 months of the life of the survey. And so late 2015, early 2016 was arbitrarily assigned as the base. That was not a good period in production agriculture, and so that's why the numbers all look relatively high compared to that base. But we got close to some of those numbers in the middle of 22. And so, but the story for the last year or so is the sentiment. It's not that high, and again, it's a little surprising given the strong returns. But I understand where they're coming from. You have strong prices, but you also have high costs, and then those high costs might persist. And so that's a story that we're seeing. And really the drop from late 20, early 21 down to where we currently are, that's when input costs started increasing. As you know, input costs started increasing rather dramatically, impact the 22 crop budget. Break-even prices for corn, for example, used in the Purdue budget, I'm sure it was similar on your farms, was 25%. So a 25% increase in break-even prices in 1 year. Soybeans, break-even price increased 15%. That's unprecedented. If you look at a 10-year history of input prices to agriculture, they track inflation. And so 2-3% would be a representative long-term average. Obviously, we're in a different environment that we've been in for quite some time, and I'm going to talk about that in this presentation. So that kind of sets the stage for my focus on production costs. We do have two sub-indices here that I won't spend a lot of time on. The index of current conditions, this is looking at things today compared to 12 months ago, today compared to the next 12 months. It's higher right now than the index of future expectations because you start looking out 5 years or more, and it looks like we might have tighter margins than we're currently facing, and so there's not quite as much optimism when you look at those index of future expectations, as you'd expect. Looking ahead, do you expect your farm's 2023 financial performance to be better than, worse than, or about the same? I think if we did a survey in this room, I think you probably would agree that a lot of people think it's going to be worse. I'm a little surprised that 19% think it's going to be better. Maybe that's the people paying the $600 cash rent in Illinois. I read that recently. They had some auctions out there and $600 cash rent. So there's obviously a difference in opinion. What might be happening? I'm more in the 29% camp. I think margins will be tighter in 23, but there is a possibility that they could be strong. And I'll talk about that when I talk about the WASDE report. So I can see why there's a divergence of opinion in terms of what 23 is going to look like. As I indicated, respondents are very concerned about higher input costs. That's the largest bar there. That's the biggest concern by far. The second is rising interest rates. And so 2/3 of the people are interested in really input costs. Interest rates, obviously, it affects interest expense. And so that's a little unusual, to say the least. If we'd have done this survey back in late 2015, 2016, I guarantee you that lower crop and livestock prices would have been way higher than it currently is, and interest rates wouldn't even made the list. Interest rates are relatively low, and so that's the changing world that we're living in when it comes to production agriculture. And just a little bit more on the input costs. I took that slide out in the interest of time, but inflation's been relatively high, as you know, 6% in the last year, using the most readily available data for the last year. But it's 15% for production agriculture, and so it's been 2.5 times the increase in input prices compared to inflation. So very high, very high input cost relative to inflation. So let's move into crop prices, if you will. And so just to review very shortly on the WASDE, I know you've probably seen quite a bit about this, and so I'll just hit some highlights that are pretty important here when we start thinking about where prices might go. They did take down the harvested area and increase the yield. So what's going on there? My hunch is that there was more corn silage in the Western Corn Belt than they thought there was going to be. When it gets really dry on the Western Corn Belt, there's a lot of cattle out there. Like where I'm from, there's a lot of cattle feeders in Nebraska and Kansas, obviously. And so I think they chopped more corn silage than USDA thought they originally were going to, and that would explain the reduction in acres and the increase in yield. Because if you take those poor acres, poor acres out of the equation, your average yield is going to be higher. So I think that's exactly what was going on. But nevertheless, it did drop production, 200 million bushels. Which is not chicken feed, as they say. Unfortunately, they also dropped expected exports, and one of the things that's really been hindering corn prices recently is exports are lower than last year, but they're running behind even what this forecast suggests that they're going to be, and so that's a big concern in the corn market. That's the two things that we're really worried about. In terms of corn, or the things that are very important from the WASDE report. The stocks to use is below 10%, and so it wouldn't take much of a hiccup in weather in the U.S. and other places in the world to see some spikes in corn prices this summer. So that's something you definitely want to look at. The stocks to use is tight enough, and right now the industry reports I've seen. Expecting corn acres at 92 million. So that's kind of what the market's got factored in there. And trend yield. We didn't hit trend yield last year. And so if acres is lower than that, and we're below trend yield again, we could see again a spike in corn. And so there definitely is some upside to corn, but there's also a downside. If we plant a lot of corn acres, and if we're above trend, and Brazil plants a lot of second crop corn. They plant a lot of soybeans, and so if they continue to increase the second crop corn and their yield increases like it has been, and Ukraine-Russia conflict is resolved, you could see more supply. And so there's just a wide range of possible corn prices, and that's why it's so important to watch this very carefully. And as Chris Hurt used to say, this is one of those years where you really want to look for spiking corn prices in that May-June period. And if you see it, and the corn price looks like it's better than your break even, start marketing some of that corn crop for 23, because there is downside risk in this market. This is showing we're below trend by quite a bit, compared, and we have been for 3 out of the last 4 years. And so that's one of the reasons why our stocks to use is relatively tight. We haven't had the really high corn yields that we saw there for a long stretch of years. This just shows when it's red and light red and dark red, means that they were below the previous year. So that's what I'm highlighting. I'm not going to necessarily go through these individual states. I got bigger fish to fry, if you will. But I did want to show you this, that most of the states, with the exception of Illinois, Missouri, and in Minnesota, that's some of the more important ones, had lower yields. But having said that, Iowa still had a 200 bushel average. Indiana still had a 190 bushel average. And so that's not what brought down the trend yield. It was that corn, it was that Western Corn Belt or the Great Plains. Nebraska and Kansas have a lot of corn, and those yields were terrible out there. Even on the irrigated corn, it was much, much lower. They just simply did not get enough rain to have decent yields, even on the irrigated. And they do have limits on the water they can use. And so when you have a dry year like this, they run up against that limit, and they don't have a lot of flexibility in terms of increasing rain, increasing the irrigation amount. And so that's a problem, even for the irrigators when you have just very little rainfall. So moving to soybeans, it's a similar story on soybeans. They reduced the harvested acres and the yield a little bit, which was a surprise to pretty much everybody in the industry. But again, the bad news is they reduced the supplies, so that means it's positive to price. But the bad news is exports are not clicking along as well as we expected them to, or USDA expected them to, and so that was kind of a wash, that reduction in production. But the stocks use is really tight. So the same story with soybeans as we saw for corn. The industry is expecting 87 to 88 million soybean acres. You add those two together, that's 180 million. We didn't have 180 million corn soybean acres this year, and so that's kind of what the industry is expecting. Very little prevent plant. I keep hearing that we might have a wet spring, so you wonder what that prevent plant is going to look like. But nevertheless, the industry is expecting quite a bit of corn, quite a bit of soybean acres, and trend yield. And so if those things do not materialize, you could also see a spike in soybean prices. Very low stocks to use. I don't have a historical stocks to use chart with me today. But Jim usually covers that on the webinar. But I can tell you that when you get that 5% territory, you're getting into some very tight soybean years like 10, 11, 12. We're back where we were, quite a few years ago in terms of stocks to use. And another thing that's really interesting is just 3 or 4 years ago, we were worried about what are we going to do with all these soybeans, and that took care of itself. With some tight supply years. We had that 1 year, we had a lot of prevent plant, and it pretty much took care of the supply situation. Meanwhile, Brazil is increasing their acreage, but given the fact that U.S. has tight stocks to use, you look at the world stocks to use, it's also relatively tight. The world can absorb that increase from Brazil and still keep prices relatively strong. Not as strong as what they are right now, but certainly not dropping down below $10 or anything like that. Soybeans yield was also below trend a little bit after a couple pretty good soybean years, and so that certainly is helping prices. And then soybeans is even more so that states did not hit their previous year mark, but last year was a really good year for soybeans across a lot of these states. Illinois still has a 63 bushel average. Indiana 57.5. These are not bad averages. But when you get out to the plains again, you're just looking at some really low soybean yields, even higher percentage declines than corn. Soybeans are not irrigated, and so the non-irrigated soybeans were pretty bad out there. And then you look at North Dakota, and man, they had a good soybean yield. Last year was terrible in North Dakota, so that's not even average. If you look at their soybean yield, and so it's no wonder that we're pretty tight stocks to use, and so we're blessed out here in Indiana. Hey, Indiana's a great place to live anyway. I'll throw that in, but we're blessed out here. We had some pretty good crops, and other places didn't, so we're taking advantage of that. It happens the other way. One year, I know my brother was farming in Nebraska, and we had below average yields, and his dryland corn was 240. And so he was kind of snickering there. Well, he wasn't snickering so much this year. I mean, things weren't too good. What about 23? Good question. So here's the acreage map. If we have 92 million acres of corn and 87 million acres of soybeans, we didn't have 180 million acres the last couple of years. And so that's really pumping up the corn and soybeans. And the question becomes, at the expense of what? Wheat prices are not necessarily terrible. And so if you look at spring wheat in North Dakota and South Dakota and some of those places, you're probably going to see some decent acreage of spring wheat. And so it's kind of a head scratcher where exactly those acres are going to come from. I think the market's counting on fairly low prevent plant. So that's the situation in. So get for corn and soybeans, look for that possible spike. If we have any weather hiccups in the U.S., late planting, anything like that, you might see a spike in either corn or soybean prices. I'll talk about renewable diesel and biodiesel at the end, because that's something that's a real wild card for soybeans. I just updated this yesterday, and so even though it might not be today's prices, I can still make the point I want to make. This kind of gives you an indication on how much downside and upside risk there are for corn and soybeans. And so this is a tool I use all the time to take a look at the distribution of prices. And so if you're going to look at your cash flow sensitivity to different prices, use this tool right here. These are futures prices, so you need to adjust for basis here, whatever your local basis would be. You need to incorporate that. But you can see there's a 25% chance. The way to read this is 25% chance that corn could be below 494. Ouch. I'm expecting, most people's break evens now are closer to 550 if you account for all costs. And so that would be really ugly. The expectation, the kind of the median expectation is 572. That's very close to what the current futures are trading for December 23 corn. This is December 23 corn. And then there's a 25% chance that corn could be 662. So that would be as good, if not better, than what we saw this last year. And so you can see why there's that divergence of opinion. Is there's a possibility for there to be a really bad year and a pretty good year. And so that's just the kind of the world we're living in right now. And so I think you have to plan accordingly, and do multiple cash flows if possible, and ask yourself, what would happen if we had relatively low prices? Can I make the principal payments? Ask yourself questions like that. But on the same time, the high prices, what would I do if I had relatively high prices? Maybe there's a piece of machinery that I haven't been able to buy, for the last year or two. Maybe this is the year to buy that machinery. And so that's the way I think about using different prices in your cash flows. I think this is a good year to not just use one price in your cash flows in your budgets. And please tell me you're doing budgets. Please tell me you're doing budgets. So let's combine these prices and some of these yield projections into some net return projections. So I'm going to start by talking a little bit about fertilizer. And I know Jay was at the Top Farmer. Was there anybody else at the Top Farmer conference? We had a speaker from the fertilizer industry talk at that conference. And one of the things that he said is fertilizer prices are elevated right now. And correct me if I'm wrong, Jay, but elevated prices, fertilizer prices are relatively elevated right now. And it's not that they're necessarily going to reach that peak that we saw, but they're not going to crash either. And so that was certainly bad news for fertilizer. And so when you look at the 23 budgets, my fertilizer cost expectations are lower than 22, but it's certainly not anywhere near where we were prior to 22. And you can see this on this chart. These are anhydrous prices using USDA Agricultural Marketing Service Illinois data. They call retailers and then publish this data every other week. It's a good source of where prices are. in the Corn Belt. Iowa also publishes this. And so as long as fertilizer prices stay up there, we're looking at some pretty high fertilizer cost per acre. And again, not expecting those to necessarily drop precipitously. You can see here, we have seen some drop in phosphorus and potash, but again, that industry expert was saying that you don't expect those to come back to the levels that we saw, prior to 22. They might come down, they might be lower than what they were in 22, but they're not necessarily going to crash. And so you're looking at some pretty high anhydrous phosphorus and potash. And so that's kind of the expectation for fertilizer. And so that's going to keep that break even up there in that 550 range for the foreseeable future, because I don't see cash rent coming down. Does anybody? And so cash rent is going to be up slightly. Fertilizer costs are not coming down very much. What other costs are we going to get some help from? Energy, perhaps, but I think energy prices will continue to be elevated compared to what they were 2 years ago, just given our energy policies. And then interest costs are up, and so I don't see a huge opportunity to cut costs in the 23 and perhaps even 24 budgets. Which makes that low price scenario rather scary. I want to say something about interest rates here. And the way I would, let me talk first of all what we got here. This is the monthly federal funds rate. This is the overnight rate that large banks, borrow money from the Federal Reserve System. And so obviously you can't borrow money the same rate as they do. In fact, if you look at operating interest rates, add about 3.5% to 4% to these numbers, and you come pretty close to where operating interest rates are in agriculture. So 3.5%, 4%. But the point I want to make with this chart is since about 2009, we've been in very uncharted territory. And I think that's an outlier. Because of the Great Recession in 2008, the Federal Reserve took those interest rates almost down to zero. They stayed there for a long time. And then in 2016, they decided, well, we're going to normalize these interest rates a little bit. They did that for a while. And then what happened? COVID. And so then they took them back to zero. Now they're to tame inflation. They've increased 4% in 2022, and probably they're going to increase another percent at least in 23 before they reach their high. And so really what I wanted to point out here is our interest rates are going back to where they were in 2007. Did we have 5% operating interest rates in 2007? No. So they're heading back in that 9 to 10% territory when you look at operating interest rates. Even the prime rate, which is the rate published by the Federal Reserve System, even the prime rate, that's for the best customers. They always that's how they define that, is 7.5% right now, and probably going to go up to 8.5% this year. And so I can't see how we're necessarily going to have anything but relatively high operating interest rates compared to what we've seen. But all that really is, in my mind, is normalizing the interest rates back to what we were prior to the Great Recession. This is just looking at the forecast a little bit. Having looked at this forecast a little bit, you can see that the blue bars, 23, 24, 25, those are not my projections. That's the Federal Reserve system. And so the Federal Reserve Board is setting those expectations. They keep increasing those. The 3.1, it wasn't very long ago, that was 2.5. And so what that means to me is inflation's a little tougher nut to crack than what they thought it was going to be. And so they've got that, it's going up to 5.1, which is another percentage compared to that previous chart. And they've got it staying relatively high in 24 and 25. And so even at 25, if you add 4% to that, that means that operating interest rates, even after we get done trying to tackle inflation, they're probably going to be in that 7.5% to 8% range. So relatively high compared to where they were. Does that matter for asset prices? Yes. When you're buying machinery, you're building a hog barn, you're putting up a grain bin, that's your opportunity cost. Is that interest rate, and so that's going to tame those asset markets a little bit. And I personally think it's going to have it's having an impact, and it's going to have an impact on the land markets. Now, when you look at the land market, you got to realize, and Howard will talk about this in more detail. But when you look at the land markets, there's a lot more going on besides interest rates. And so just because you have one factor that's pushing land values down, you have other factors that are pushing it up, such as strong demand from outside, institutional investors, or just alternative investors, period. You also have high inflation. Land's a good hedge against inflation. As long as net returns stay relatively strong, that also puts upward pressure on land. So land, you've got countervailing forces, if you will, pushing on the land market. But that's different than where we've been the last 2 years. The last 2 years, almost every factor affecting land values is positive. That's why you saw the 20, 30%, depending on where you are at, increase in land values. That's all. Those increases, in my mind, are over, and now we're coming back down to earth, maybe down to the 5 to 10%, something like that. Notice I didn't say negative. It still remain positive to some positive factors. Looking at break-even prices, I alluded to this. Even on the high productivity ground, using the Purdue budgets at approximately 550 for corn. So that low price would look pretty ugly there. A higher break even for the average productivity. Just put some numbers on this. The average productivity is 185 bushel corn. That's about the trend yield for Indiana. And then the high is 215, 220 bushel corn. So in the high productivity, you do have a lower break even price. It's low. This is your 155, 160 bushel corn. The marginal ground break even price on corn is really high. Because the way that happens is a lot of the costs you look at when you go into a budget, they reduce a little bit on the low quality land, but not much, not very much. And so that when you divide that per acre or per bushel, it really makes that break even high. If I was back in 21, this is good, tells you good my forecasting ability. But when I was back in 20, that was the blue bar out there in the high. I was telling people, keep that break even under 4. Who knew that, 2 years later, I'd be saying, keep it under 550. So that is a big change. And that's not going to come down very fast. In fact, I think we're going to be in a situation probably in the foreseeable future where our break even is going to be higher than the prices. I mean, you're looking at some pretty strong prices in 23. If you go out and look at, I know that's a long ways out and 5 million things could change. Start looking at those very extended futures and you look at USDA forecast, you're looking at corn prices closer to $5. And so that may not materialize, but that's what you're looking when you look at those long run forecasts. And so there will be some pressure to reduce those break evens long term. And yes, break evens do come down once in a while. In 13, we had relatively high break evens and they came down. So they don't always have to go up. Soybeans is a similar story. The difference here on soybeans is there's at least right now, using average numbers, it looks like soybeans are slightly more profitable than corn. And so that's reflected in the break evens and reflected in this chart right here. This is kind of a difficult chart, but what I'm trying to do here is the blue is the return over variable cost. I call it contribution margin for corn, and the red bar is the return over variable cost contribution margin for soybeans, and the green bar is land costs, opportunity costs of machinery, and labor. And so what this is telling us is is the return over variable cost contribution margin big enough to cover all those overhead costs? And for soybeans, even on average, it is. And so right now, soybean prices are pretty strong. We'll see if they stay that way. There was some weakness in soybean prices this last week. So we'll see what happens with soybeans. Every news we hear from Brazil and other places is going to shock the soybean market because the stocks to use is relatively tight. But right now, soybeans looks a little better than corn, but corn looks pretty good on the high productivity, and it doesn't look terrible on the average. And so, you compare these to 2020, 2021, these are still decent margins. Not 21, 2020, 2019, 2020. Combining that corn versus soybeans, I'm combining that into a chart here, and these are using average productivity here. It might look a little different on low or high. Corn's relatively more profitable on high, and typically, and a low, soybeans are more profitable. So that would be the changes. But when it's red like this, like you see for 23, that means that right now soybeans look more profitable than corn. Does this mean we're going to see a lot of second-year soybeans? Probably not, but at least on the margin, it means that we're probably going to see more soybean acres than corn acres again in Indiana. This will be like the 6th or 7th year in a row where we've seen that. And I know as you get closer to the Ohio border here, you guys do tend to plant more second-year soybeans, it seems like. And so perhaps this is one of the areas in the state where you'll see some second-year soybeans. But that's certainly where the economics is falling out right now. We look at the net returns. Like I said, it's more similar to 20 right now than 14 to 19. And so 23 doesn't look terrible, but compared to 21 and 22, it's not very good. And this is why after this year, we're not necessarily going to see as much upward pressure on cash rents or land values. If these margins do materialize and we have relatively lower margins in 23 and 24, that doesn't mean they're going to be negative because they're not that low, but it does mean that there's going to be less pressure for those to creep up. That's what that is telling you right there. But remember, there's a wide band there. I got to use both hands here. It could be a high prices, could be low prices, and I know we always say that as Outlook people, as economists, but this year particularly like that because of this high stocks to use, the conflict in Ukraine, and a lot of other reasons. There's just a lot of uncertainty where corn and soybean prices are going. Let's go back to the Ag Economy Barometer and see what they think with land values. And so they're still optimistic on land values. We don't ask what the percentage is, but they're still optimistic that land prices are going to increase 12 months from now. That's the 39% to the far right there, but a lot less optimistic than they were a year ago. Not surprising, really, given the increase in interest rates in particular, and the prospect for tighter margins. There's also the percentage I think they're going to be lower is creeping up. Where would I fall? I would be within 39%. I think we're still looking at historical increase in land prices is 5%. I still think we're in that. We're still looking at 5 to perhaps up to 10% in land values in 23. So I still think we've got some upward pressure there on land values. Looking 5 years from now, there's 16% think that they're actually going to come down in 5 years. That's pessimistic. I would be with the 56% that we still have enough positive factors on land values that they're going to be higher 5 years from now than they are right now. And so even the margins look lower in 23. They're not falling down so low that we're going to see, and that we're going to see downward pressure on land values because of margins. This is a kind of mimicking the Purdue cash rate and land value ask for information on several factors. I've summarized those factors into 6 buckets. I wanted to make it a little simpler for the people that were calling on the phone for Ag Economy Barometer. And I was a little surprised at these results, but there's not one thing on their mind in terms of influencing farmland values. There's really 4 main bars there: net farm income, interest rates, alternative investments, and inflation. Now, we don't ask whether it's negative or positive. We just ask them, is it influencing them? I personally think they're underestimating this one. I think this one's been huge to the land market in the last couple of years. And as long as we have strong liquidity out there, that does bode for some strong bids, for land. But having said that, be very cautious in how you use your liquidity here in 23 and 24. I always say that. So if you heard me talk before, I always say that, but I think it's particularly true this year because as the margins drop, you really need that liquidity to make sure you can pay term debt. make term debt payments. And so don't use all that liquidity to buy assets. I don't think that would be a very prudent thing to do. And most farms don't, but I would be remiss if I didn't say something about that. Ag policy is really not on people's radar. We really haven't had any farm payments the last couple of years. I think you asked me to talk about our county and the PLC. I'm not expecting any payments. We're so far out of the money right now, but it seems to me to make sense. Our county it has a bigger chance of paying out the PLC. The PLC price of corn is what? Remember? 370. Is corn dropping below 370? Might be a 1% chance, maybe. So you're not, and so the PLC prices are so low and so low on corn and soybeans. The PLC price on soybeans is 8.4%. Then you're getting into decimals in terms of percent chances. Those are not going to pay. Wheat's a different ballgame. PLC is usually a pretty good bet for wheat, but for corn and soybeans, I think our county makes more sense because there's a bigger chance, not a very big chance, but there's a larger chance in PLC that you might see some payments there. Just some final thoughts. I think I have a couple minutes. Okay, so just some final thoughts. I just threw some stuff on the slide here. Some things that we could, perhaps if you'd have questions about or something like that. What are some of the key factors here? Well, one of the reasons why I'm so bullish on production agriculture long term is where are we going to come up with more acres? I know we've been saying that for a long time, but you start looking around the world, and Brazil has a chance to increase more acres. That's what they tell me. Maybe if Russia got their act together, they could also increase more acres. I think there's some land in Russia that could be put into production. It'd be nice to get Ukraine back into full production. But where else is it going to come from? And so that's going to be a positive for U.S. agriculture for a long time to come. It also, I'll get a little bit on my soapbox here. It's also important that production agriculture stays engaged with energy policies. I get really nervous. I know we're not the European Union, but I get really nervous when I see countries in the European Union that are looking at cutting things like fertilizer. We need the crops to reduce poverty and to feed and to make sure everybody has enough food in the world. The last thing we want to do is to have policies like that curtail production, because we're not going to get production from world acreage. And even if the U.S. and European Union decided to reduce fertilizer, for example, for some odd reason, that's going to cause environmental damage in other countries as they try to bump up supply. And so that's just a non-win. Instead of a win-win, that's a no-win, no-win. And so I think it's very, very important that we continue to increase productivity, continue to increase output, and we've done a truly amazing job in the U.S. Increasing output of things like corn and soybeans without really increasing input. I didn't say input costs, input. Think about fertilizer. The fertilizer recommendations really haven't changed since the mid-90s. And I think we've probably put it on more efficiently too. Certainly we do. But what's corn yields done since the mid-1990s? We're increasing 2 bushels a year. So that's what I mean by productivity. I think it's very important that we continue to do that through all kinds of innovation, increased management. Precision agriculture fits in there. And so that's going to be very important, that we continue to increase corn and soybean yields in the U.S. and around the world, because we're not increasing world acreage. And my point is, we can absorb that extra production because of the increasing population and the increase in incomes in the world. And so as long as the world economy stays relatively strong, we're okay. On the demand side, there's also some question marks. I think biofuels, obviously, with the electric vehicles and some of those things, got worried a little bit about ethanol, but I think that's a long time out. That be necessary. That's not going to be the next few years. And I promised to say something about biodiesel. I think biodiesel, renewable diesel, those markets could expand and could expand rapidly. Will they? I don't know enough about those markets to know what the probability is that we're going to see major expansion there. But nevertheless, there is plants being built. For example, in north central Iowa, I think they're putting in a couple big plants up there. And so there is some plants being built there. Just if you think the competition for acres is strong now, wait till what would happen if we have biofuel increase in biodiesel demand. It would be truly crazy. But that certainly would be positive to prices. We won't talk about whether that makes any sense. That's not what we're talking about here today. That's not for me to say anyway. I'm not an engineer. It would be positive from a soybean demand standpoint. And we'd probably be in a situation where we're exporting meal. We don't export meal, but we might be in a situation where we're exporting meal because obviously we need the oil for the fuels. China, that's a big question mark right now. China, one of the reasons why the exports are down for corn and soybeans is the Chinese economy has been struggling a bit. Now, when they struggle, that means they have 5% growth rather than 10% growth. But nevertheless, they've been struggling a bit. They've had a difficult time getting over this COVID. And for the first time in decades, their population is actually declining. And so the question mark there is, what is long-term demand going to be in China? It's a real question mark. And then you throw in some of the issues related to China and U.S. relations and all that stuff. And so the demand for China is kind of a question mark right now. Hopefully it'll stay relatively strong. But certainly the population per capita income is working in our favor, increasing demand. And so you put all this together, and I think there's some reasons to be quite bullish for production agriculture long-term. And U.S., I think, is going to be a pretty good situation in terms of taking advantage of that. And so I think if you look at the eras in production agriculture, you look at the 73 to 2007 pre-ethanol, post-export pre-ethanol, and then you look at 2007 to today, we're going to continue that 2007 to today price levels. That doesn't mean we're going to have $6 corn, but it does mean that corn prices are probably going to stay $5 rather than drop back to where they were pre-2007. And so that's good news, because we always worried, I don't know about you guys, but I always worried after 2007, how long is this going to last? I would have never thought it would last as long as it did, those elevated prices. But we continue to find, because of some of these factors here, we continue to find markets for our increased commodities. Biofuels has certainly helped there. Find export markets and so on. So it's made this newer era continue a lot longer than a lot of people think, and I think there's good reason to think it's going to continue into the future. And so you might not think $5 corn is that high, but compared to where we were before, that's pretty strong. So that was my main comments I wanted to make. I have some time for some questions, food for thought, whatever's on your mind. Someone needs to ask one question, make me feel a little better. My focus quite a bit long term.
Carbon crops, something is that so far in the future, or is that realistic, or carbon credits? What are your thoughts?
It really depends on what's happening, what's going to happen to this ESG ratings for corporations. One of the reasons why that came about is corporations were scrambling to try to improve their ESG rating. And long term, I don't know where that's going to fall out. There's been a little pushback by some states and some people regarding that. And so it really depends on how that falls out. If that ESG ratings remains important or becomes more important, there will be even more push for the carbon. But quite frankly, we've done some questions on the Ag Economic Barometer related to carbon. There's interest out there. The problem is they haven't paid enough when it comes right down to it. And so I don't think they will necessarily unless those ESG become a more important thing. Well, there's several very large world organizations that are pushing that really hard. World Economic Forum is one of them. But I think there's a group in the U.S. would also, BlackRock and some other groups in the U.S. would like to see those implemented. And so I don't know how that's going to fall out, because like I said, there has been some pushback against that. But that's going to be relevant factor. And when we ask people, there's quite a few people that actually talk to people, but when you actually ask them if they actually signed a contract, the number was way down. And when we ask them why, it's all related to money. Good.
Did Ukraine get their fall crops planted and planted well, and then will they normal this spring?
No, it won't be normal. I think what I read is the crops that they actually harvested, I'll start there, was higher than people thought it would be. I think it was like 2/3. They had like 2/3 of crop. People didn't think it was going to be that high. That's the kind of number that I would use. Is it's going to be a fraction of full production. And for Ukraine, as you indicated, the wheat's important, but it's also corn. And they're very important producers of wheat and corn. With Russia, it's wheat. But I just keep waiting for that Black Sea region to, they're a powerhouse in production, but I just keep waiting for them to become more of a powerhouse. It's conflicts and other things hold it back, because you've seen that map, I know, because it was showing Top Farmer, but I've also seen that map. So let's talk a little bit about where the good soil is. There's only really 3 regions in the world that has the best soil: here, Corn Belt, Black Sea, and Brazil. Here in Brazil, they've got their act together and it really increased production. Russia, not so much. Not so much. There's no reason why I can't. I'm not an agronomist, but I see no reason why Russia can't produce more corn in that region. And they haven't done that as much as you expect them to. They've been increasing the wheat and increasing the yields in the wheat. But quite frankly, their government right now is not conducive to seeing the improvements that we've seen in the U.S. and Brazil and Argentina. Yeah.
Maybe this is just a local thing, but how about ground taken out for solar?
We've been asking people in the Ag Economy Barometer related to solar too. If you look at nationwide, it's fairly limited, but in Indiana, it's not so limited because we seem to be the place where they want to position the solar. And so I don't see that necessarily tapering off anytime soon. It goes with the energy policies again. Our current energy policies: increase wind, increase solar. And then if that ESG takes off, do the carbon payments. And so that seems to be the direction we're going. But quite frankly, it depends a little bit on the 24 election, I think. Good questions. Okay, I'll turn it back to Amy, and I am going to take off after this. And so if you do have any questions, just send me an email. My email information's on the Center for Commercial Agriculture website.
Thank you. If you guys are not familiar with the website, the Center for Commercial Agriculture, check it out. There is lots of good information on there, and a lot of the this information that Dr. Meyer has shared today. So,
and I did forget, if you have any knowledge of customer rates, please fill out the survey and give it to Amy. I could really use some more surveys.
yeah, fill those out before you go, and I will stick those in the mail. I get lots of phone calls from property owners about what the going rates are, and so and sometimes those surveys, we don't have a large number to get a good accurate amount of what all the numbers are for agriculture. So hopefully you guys are enjoying lunch, and I would like to thank Haldeman Farm Management and Real Estate we've partnered on this event together, and I think it's been a good partnership. And then they have provided lunch for you today. So I'm going to turn it over to Chris. He's going to introduce his team that has the office in Winchester, and then we'll introduce our next speaker.
Thank you, Amy. We'd like to thank everybody for coming out, braving this weather to come join us today, and in person and online. We've got quite a crew online as well. I think it said 34 participants online. So thank you all for joining us. Our local team has been a great part of this, and I think most everybody here knows Carla, my wife, back there, Abigail Chalfant, and Lauren Peacock. So glad you got to meet our local team. Our office is right up the road here. Feel free to stop in, say hey anytime. We'd sure love to have you. Amy's team, we really appreciate working with Amy on this. Both of us like to accomplish the same goals here, and we make a good team working together on this. So thank you very much, Amy. Without further ado, I'd like to introduce Howard Halderman, president of the Halderman Companies. Howard has a great wealth of knowledge, not only for Indiana, but all over the country and world in different projects he's involved in. So after Howard's presentation, or even along the way, feel free to ask Howard any question about anything. He's really great on topic, but you get him off topic and you learn so much from him. So enjoy the presentation. Thank you.
Thank you, Chris. And I know that Amy said she might need to adjust the sound there in the room. Those of you on Zoom, welcome as well. I think between the two, we're somewhere 70 to 80 people in total.
Hang on, Howard, just a second, please.
Sure.
Okay, you want to give us a little test?
All right. Does that sound any better, Amy?
Is that better? Is that good? Yes, thank you.
Great. So again, welcome everyone. I think we've got 70 or 80 people that have joined us today, either online or via in the room. And you guys you get the award for braving the weather today. I obviously chickened out and chose to remain in Wabash. Something about, red travel zones and all that jazz. But this is should be a very interactive. I hope it will be an interactive presentation. I know Nolan Sampson, our Director of Business Development, is also watching online. He's going to kind of watch the chat. So if anybody online has questions, just type them into the chat. There's Nolan right there at the top of your screen. And so just at any point you've got a question, let us know one way or the other. We'll try to get those answered, as Chris said. A couple of comments following up Michael's presentation, and Dr. Langemeyer does a terrific job. The Center for Commercial Agriculture is an excellent resource for the producers in the state of Indiana. And Michael had a couple of topics. One question came up about solar. And we have gotten involved a little bit working in solar. Obviously, we manage a lot of farms, and we get clients that have the opportunity to maybe look at solar for their farms. There's some projects underway, but very few acres today are in actual solar production. So to have an impact on the marketplace today, it's not had a lot yet. But as Michael said, Indiana, because of it being the crossroads, not only for road vehicular traffic, but also for electricity, there's a lot of demand here, as well as in Ohio. So that I think will evolve over time. You'll have more acres go into solar fields, and that'll have a small impact probably on overall crop production. I had a question last night. We did this same kind of seminar in Lafayette. And one of the questions there was, what about all the residential developments taking land out of production? And that is true. There are acres being developed every year. Michael said 92 million acres of corn being planted next year. You're looking at 90 million acres of soybeans potentially. We really haven't seen a significant percentage of any of the row crops being converted into other uses yet. It's impacting the overall corn and soybean market. What does have an impact on the land market from residential development is the income, the actual sale of real estate. And you probably have heard about this coming out of the Boone County projects, where folks are having the opportunity to sell land for $50,000, $60,000 an acre, even more. And that 1031 exchange money does have a material impact on the farmland market during the time period that those things are existing. So a couple comments on that. The other comment I will throw out is on the ESG. That ESG is different than carbon. Carbon credits are a component of ESG, but that's really all about the E factor in the ESG statement. Publicly traded companies, Frito-Lay, ADM, Wells Fargo, those are all publicly traded companies. And the SEC has come out with a ruling or a new law saying that those publicly traded entities, and this is all due to the BlackRock organization, which invests in these companies. Michael mentioned them. The SEC ruling basically says you have to tell us how you're managing your tier 1, tier 2, and tier 3 ESG. Tier 3 is the farmer for ADM or for Frito-Lay. And there's no right or wrong answer today. There's no federal statute that says, here's how you do ESG production agriculture. There's no state rule on that. So that's evolving. Halderman's got a little bit of activity in that area. So watch it. It's not a concern today, but that's something that I think those companies are going to be dealing with. So I'm going to start sharing my screen, and hopefully you are able to, I see it there through Amy's view, and you're able to see what I see. So again, we're going to talk farm real estate today. Michael covered really the commodities and where those markets are moving, and obviously they are a huge factor in farmland values. But you know a little bit about the Halderman companies. I think Chris mentioned that his team there in Winchester, and they have a fantastic team. That's Chris, Carla, and Abigail. But we are a 92-year-old company. Been around since 1930. My grandfather there in the middle of the screen, the company here in Wabash. And we've got representatives like Chris and Lauren all over the state of Indiana, Ohio, and Michigan. And we represent landowners. So my comments today are going to come from a landowner's perspective, be it cash renting, be it land values. We represent landowners, which many times are a farm operator, but not always. So that's the perspective we bring. And you can see some metrics here. You know, we do farm management, we do farm real estate sales, and we do farm appraisals. So we might engage with you on any one of those service areas, and you can see a little bit of the scope of our business. And then on this slide, I just want to point out the last point here. Our average tenure of our staff is greater than 20 years. I'm not suggesting anything about Chris's age, but he might be on the longer side of 20 years. I am certainly on the longer side of 20 years. Lauren's on the shorter side of that. So that's kind of how we come up with that average. And it really means that you get experts in your area. They know the land market, they know the tenants, they know the cash rent market or the leasing market. And I think that brings real value back to that community, in this case, Winchester and Randolph County. And then you can see the various areas we work in. So as Chris said, I do have some experience across the country. If you want to talk about those other crops, we're really going to focus on Indiana today. And farmland values, I think, as everybody knows, and Michael alluded to this, have been super strong. They've been moving up, and a lot of factors in that. Farm incomes are one, but supply of farms for sale is another factor. And one of the things that drives supply would be an outside factor like potential tax law change or a farm bill change, or maybe the overall debt structure. And we'll talk about each of those. But there really weren't any outside drivers to motivate a landowner to sell farms really from 2013 to 2020. It was a very thinly traded market. Now, last fall, 21 and fall of 22, we saw that market return. You may have thought, oh gosh, there's a lot of farms selling. It really just returned back to a normal marketplace. Normal being roughly 2% of the farms that sell in a given year. So we were below that, closer to 1% for a number of years. And then we saw the fall of 21 and the fall of 22, that numbers increase. Now I would say first quarter, the way things are looking, we're probably back a little bit below normal in terms of the volume of farms on the marketplace. That's supportive of the land market. It makes it tough if you're a buyer, but it's good if you are a landowner. So as I said, the number of sales improved. And the question really is, for 23, what do we see the remainder of the year? Interesting dynamics. You're at the all-time high, inflation adjusted, your all-time high of farmland values. So if you are a true Warren Buffett aficionado, buy low, sell high, you're at a sell high moment. And I bring that up because we have some landowners that have decided to sell because they are at the all-time high of farmland values. I'm not suggesting you want to sell. I'm just pointing out that that's kind of the market we're in today. So if they look out 2 to 3 years and say, okay, gosh, because of family dynamics, because of generational change, maybe we want to sell the farm in the next 2 to 3 years. When do you want to do that? And if you listen to Michael and kind of his projections going forward, you may say that today might be a better time than a year from now, because we could be looking at lower commodity prices going forward and higher interest rates. So those are some things that are swirling out there. There's no crystal ball on them, but I'm just cluing you in as to what some people have told us. As I said, cropland values have been super strong. They were stable from 2016 to 2021. Then we saw them jump up 30, I would argue maybe even more than 40% over the last 18 months. We're at the all-time high, even inflation adjusted. Now, as you know, in East Central Indiana, it's not all about cropland. You've got timberland, you got recreational land, you got residential properties. Those tend to trade more with the general economy. So as the general economy moves, unemployment changes, interest rates have a bigger factor. All of those markets may change due to that. They have become they were pretty strong with low interest rates, and certainly with the changing demographics due to COVID. A lot of folks said, hey, I can work from home and I might want to live out in the country. And so you saw a little bit of movement back toward the rural lifestyle. That was positive for all those types of real estate. Now with higher interest rates, are we starting to see a little weakness or at least steadiness into some of those? I had a question in an interview after the Purdue Land Value Survey came out last summer. I was doing an interview for Indiana Agri-News, and she asked me, what was I surprised by? And I was not surprised by the cropland values. We'll get to that in a second. I was surprised by the recreational value, and the recreational value in that survey was $9,000 an acre. I just thought that was super high for recreational land. Those are things that can come off that number pretty quickly due to economic times. So we'll start big picture. This is USDA cropland values. This is going to be a little smoother as we progress through time because it's all cropland from California to the East Coast. And the average in 21 was at $4,400 an acre. It was up almost 10% from over 2020. That's not representative of the Corn Belt. The Corn Belt was stronger than that in 21, but it certainly shows that it is consistent across the United States. We are in a stronger land environment. Now we'll get a little closer to home. The Federal Reserve Bank of Chicago, they do a survey every quarter. These are FDIC insured banks. So not Farm Credit, not Beacon Credit Union. These are other banks that are out there. First Merchants would be an example right there in Winchester, where they are submitting their opinions as to what farmland values have done over the last quarter and over the last year. And you can see the I states performed pretty well November to November. And I had a question last night, well, why is Indiana special? Well, I don't think the Indiana special in this. It's just that Indiana ag bankers felt like our values were up fairly strong. I will also point out to you, Michigan did not have a zero change. Michigan didn't have enough survey responses to put in a number. So I don't want you to think Michigan was lagging there for any reason. But the overall 7th district up 20% November to November. The market is certainly up more than that. So now we'll get really close to home, and this is Indiana, and this is the Purdue survey. So these are 3 different surveys. We'll get into specific numbers on the next slide. But you can see at the far right-hand side of this chart, that hockey stick move up. Now I'm wondering, Amy's sidebar there is kind of blocking that right-hand side. But the hockey stick move up had best land in Indiana at $12,750 an acre. All of you probably in the room have heard of sales that were $15,000 an acre. We've had 3 this year so far. So I don't want you to think that that's the right answer for your specific farm, but it certainly gives you direction. It gives you a feeling for where this market is moving, and it certainly jumped up quite a bit over the last year. This is a June survey. So when you think about this, it's not representative of where the market is today. This was June of 22. So now we'll talk specific sale results, and these are actual sales that Halderman conducted over the last couple of years. And one of the ways we evaluate our sales is we take the productivity index, WAPI, weighted average productivity index, that's that WAPI that you see there. Every farm can be mapped in the state of Indiana for its ability to produce corn based upon the soil types that exist there. And you might have it range anywhere from 100 to 185 bushels of corn per acre. That's not indicative of what it'll actually produce. These surveys were done a number of years ago, and Purdue and USDA combined on that. But if you have a farm in Randolph County that has 160 bushel WAPI, it's probably better than a Wayne County farm that has 135 bushel WAPI. And so probably prices are different, but it gives us a way to compare farm to farm. Now, what this chart is showing you is what's the sale price divided by that productivity index for that given farm. So the blue line are all the individual sales, and you can see there's a lot of volatility there. Every farm's unique, and so every farm's going to bring a little different number. So that's not surprising, but the trend line, that red line, is really what we want to focus on. The first half of 21 was very much like 2016 through 2020, where we traded at about $50 to $55 per corn bushel of productivity index. So you could basically have taken your productivity index, let's say that's 150 bushel, times 50 for the last 7 or 8 years, and you'd have been pretty accurate as to what the value of your farm might have been. But then look what happened in the Q3 of 2021. It almost just jumped overnight. We had 5 sales in 7 days in August of that year, and they were all over $10,000 an acre. And I sat back and I said, something in this market has changed. It certainly had. And we jumped from 55 to 80 almost overnight. And so that was a pretty big increase. And what does that really look like numerically? Here's where you look at the numbers. The first 6 months of 2021, we were at $55 per productivity index bushel. The last 6 months, we were at 80. That's an average of $71, but that's a 46% increase. Now, remember, the surveys were showing 20 to 30. So real numbers, we were looking at a 46% increase. The 20 average versus the 21 average, 51 versus 71, that's a 39% increase. And then look at 2022. We averaged $85 last year. So significant increases. Now, that's not a huge increase over the 21 average, right? But we'll talk about some individual sales here in a second that might show that we're even up higher than 85. Here's another way to look at it. Number of sales over $10,000 an acre. That's kind of a benchmark, right? Now, if you're in Iowa, it's over 20,000, but we're in Indiana, so we don't expect to see $20,000 an acre sales. But look at the first 6 months of 21, 17% of our sales were over $10,000 an acre. The second 6 months, 88% of our sales, almost 90%, 9 out of every 10 farms was over $10,000 an acre. In 2019 and 2020, we were below 10%. So it's not like we weren't seeing those sales before occur over $10,000 an acre. It's just that it was much more of a regular occurrence in the second half of 21. Now, I alluded to 22 being above $80, and you can see that trend line would look pretty flat all the way across. Some of our appraisers would say Q3 was the high of the land market. One thing I want to point out on this chart, lots of volatility, but also look at the bottom part of the graph. The distance between Q1 and Q2, and I don't know if you can see that depending on where you are in the room, but that indicates the volume of sales. Q1, we had a pretty good volume of sales. So there's a gap, a bigger gap between Q1 and Q2. Pretty narrow gap, Q2 to Q3. That's planting season. Not a lot of sales occurred then. Then a little bigger gap in Q3, so a little more supply on the market, and then Q4 dominates this chart. We had a lot of sales in that fourth quarter. In fact, normally we might have 7 or 8 sales after Thanksgiving. We had 20. So it was a very big hustle quarter. It wasn't due to capital gains tax threats or anything like that. I think you had a lot of folks that said, you know, we kind of want to sell in this off season between 22 crop and 23 crop, and we're going to do it in the front end of that. And that's, I think, really what you saw the volume. Toward the fourth quarter, we started to see what I would suggest to you is more volatility in the sales. Look at the wider gap of the blue line there. So what that means is we actually started to see some sales in the fourth quarter where we sat back and said, that kind of seemed cheap. Now, it was $12,000 an acre. So is 12,000 cheap? No. But we kind of expected that farm might bring 14. And in the Q3, we didn't see that. Everything was pretty high. If you look at the blue lines, it kind of shows that, right? So that's what we saw in Q4. And really the question was, does that continue? Now, let's look at this long-term chart. This is 2016 through 2022. This really shows that big increase. If you drew a line through 2016 through mid-21, it would be very flat along that $50 mark. And then you see the jump up to 80 and the numbers consistently going. And then the increased volatility there on the far right-hand chart of that side of that chart. Now, here's a whole host of sales. I'm not going to spend any time on most of these. I just want to point out that we have a whole variety of sales. You can have anything down there in Davies County in January of last year, $43 to $86 a whopping point. And you might say to me, well, gosh, Howard, why would something bring 43? That is flood, susceptible to flood. So don't carte blanche say everything sells for $80 or $85 per whopping point. It doesn't. When you have flood risk, it can be impacted negatively in that regard. Good soils, but not a great price. Likewise, what happens when you have a location factor involved? And they're in Hamilton County, $19,000 an acre. I don't even put a whoppy score on that because that really is going to be super high, well over $100 per bushel, largely because it's located in Hamilton County. So we'll go through these sales. You can see in February, anywhere from 7,000 to 15. And continuing in February, again, first quarter, we had a fair number of sales. There's another flood-prone sale. So before you think everything sells for at least more than $5,000 an acre, it doesn't. This one was in a oxbow of the White River. It floods every year at some point in time. So just to give you an idea what something like that might be worth today. We continue on, and you'll notice that we had a fair number of sales. There's a couple one in Delaware County at 10,000. And then we get into April, May, June, July, and that's all in one slide. So all of those sales captured in one slide. Again, not a lot of volume during that time period. And then we started to get into August. And remember, I said August, September might have been the high. I'll point out to you here that Whitley County sale, the second one there on the slide, $14,000 an acre. That was a very average farm, 138 bushels per acre of whoppy, $104 a whoppy point. That to me was a super high sale for what it was. It was a very average farm. We've been managing it, so we know it well. Lacked some tile and some fields, just the way the owners had maintained it. So that sold very, very well. Now I'll point out to you, we had Huntington County at $15,000 an acre. So we go through September, we get into October, and you might notice down at the beginning of November, that first November sale was a Huntington County sale, 325 acres, $88 a whoppy. Yeah, Howard, that's right at where the market was. We thought that'd bring 14. In fact, a month later, 2 miles from this, another farm brings 14. I looked at this sale and said, somebody missed an opportunity here. Good farm, well maintained. We've been managing it. And we knew it was better than the Whitley County farm, equal to the one that sold a month later for 14. So my point is to this volatility. There are some opportunities out there, why you attend every auction, because some will bring below what you expect. Certainly not that Rush County at 19,000. That was fully priced. But anytime you see something $95 to $100, I would say those are fully priced in the marketplace today. That 14, flip back there real quick, 14,000 in Delaware County, $87 a whoppy point. Yeah, that's a high price, but it wasn't totally out of line for the quality of the farm. And we go on, and there's another Delaware County. And now this one, I think Chris in his advertising actually said, one of the best farms, it recognized it reputationally as one of the best farms in Delaware County. And it brings $104. Now look at the farm right above it in Cass County. Sells for $6,100 an acre. Most real estate people will tell you value is all about location, location, location. Believe it or not, the whoppy score on that Cass County farm and the Delaware County farm are almost the same. A couple bushels per acre different. And you look at the values, almost double. That is location. That Cass County farm is up by 12 Mile. If anybody knows where 12 Mile is, that's an okay farming address. It's not the best in Cass County. It's not south of Logansport, which is really good land. So that is an example of one that an investor might want to take a look at. I don't think an investor bought it necessarily, but that just was a sale, and it happened. Those happened on the same day. So just kind of the dynamics that we see in the marketplace that I find interesting. We closed the year pretty strong. Had some nice sales. There's another Pike County flood-prone sale, just to give you an idea of what those bring. Now your question is, all right, Howard, that was all 22. What's happening in 23? We've had 3 auctions through Monday. We have 2 going on right now. They'll be closed later this evening. So these 3 auctions so far have been spectacular results. I didn't even put a whoppy score on that second one there in January because it was a third woods. It still brought $14,500 an acre, and it was a third woods, 80 plus acres of woods. So tremendous sale results so far, and we're looking at so far really a lot of cash liquidity. I think, as Michael said, the ag barometer score jumped up to 126. And I think that's kind of indicative of where the attitude and sentiment is coming off the best income year, arguably ever. You can follow our sales on our app. You can download that on Apple or Google. And then we'll move on to who are the buyers. So 55% of our closed sales sold to farmers last year, 45% to investors. Now, Michael mentioned that there's a lot of institutional money chasing farmland today. It's chasing, it's not catching. So these farmland investors today are more of a local person, somebody in Winchester, somebody in Muncie, somebody in Richmond, somebody in Indianapolis. The 1031 exchange money. It's not the institutional investors because the cap rate is too low. Most of the institutional investors we work with are looking for returns in the mid threes, and the returns honestly are in the low twos. So they're not really the players today. They would be. There's money out there, certainly, to invest in farmland, but the cap rate's not at that point. But farmers tend to dominate the marketplace. Now, these are our sales. Here's what the overall marketplace is. 71% farmer buyers. And you'd say, Howard, why is that number different? Well, these are off-market transactions. So this is all sales. This would be the sale from the landowner to the tenant. And a lot of times that's a farmer. And so as a result, that number is higher, and that's pretty consistent across the Corn Belt, Illinois, Iowa. You would have 75% of your transactions actually go to local farmers. So before you start thinking that institutional investors or Chinese investors are buying a lot of farmland, that is just simply not the case. The majority of the sales go to the local farmer down the road. And while I'm on that topic, and I asked this question last night, and there's lack of awareness, I think, in most farming populations. Indiana passed a law, signed into law last April, went into effect July 1st. If you are foreign to the United States, you cannot buy cropland in Indiana. Most people find that very favorable. I have a couple of clients, one out of Denmark, one out of the UK. They like to buy farmland. They rent it to Indiana farmers. I wouldn't have any heartburn over them owning land. They can't anymore. So now the fallacy in this law is it did allow, if you are involved with livestock production, you can buy as many acres as you want. I brought it up to my state senator and state representative. I said, do you know who owns Smithfield Foods? They both said no. And I said, well, the Chinese own them. And by basis of your law, they can buy as many acres as they want. And I can tell you our state representative went white at that point, because that certainly wasn't the spirit of what they intended with that. So I just bring that up. It is legislation today. So Indiana is, you can buy if you are a US citizen. You just can't if you're outside the US. Here's the ag barometer. Michael covered that. I kind of think this historically followed farmland values until the last couple of years, and it just hasn't. So I think we're a little more bearish in attitude, but there's been enough cash out there that is more than offset. Inflation is certainly a factor, and Michael mentioned this. Inflation has a 1-to-1 correlation with farmland values. That means when inflation is high, farmland values move up. Notice on this chart, and if I was in the room, I would point out, if you go to the 2022 F, fiscal year 2022, remember the USDA numbers were $4,400 an acre. That's well above that blue line on this chart. So we've been in time of high inflation, elevated inflation, according to this chart, and values have gone above that. So inflation certainly is a factor in farmland. I mentioned earlier that we are at the all-time high of farmland values if you take inflation out. That's the bottom line on this graph, nominal values. Nominal means just the highline market where you see $15,000 an acre, and certainly we're at the all-time high there. But when you adjust it for inflation, 2013 was the previous high, and we're now above that here in 2022-23. So let's talk briefly about debt. Believe it or not, and maybe you know this, Farm Credit has about 50% of the farm debt out there. Commercial banks like First Merchants and others would be 31%. And then you have the other categories, which Beacon Credit Union would fit into some of those categories, but kind of see how the debt's divided up. Now, debt is back above, just fractionally, but above adjusted for inflation where we were in 1980. And that would be scary in a lot of ways because many of us remember what the 1980s involved. But a couple of things I want to point out on this slide. Real estate debt is well above what it was back then. And what are a couple of key things with real estate debt? Those mortgages tend to be fixed and they tend to be long-term. And so they're fixed at low interest rates and for a long period of time versus your non-real estate debt, which is going to be more like your operating lines and equipment lines. Those might be at more variable rates and they're shorter term. So I think structurally this is good in the debt complex that we have longer term money out there at a lower interest rate versus where we were in 1980 at double digit interest rates. So that I think is a positive. Here's another way to look at that. Real estate debt in blue, non-real estate in red, well below what it was back in 1980. Average fixed interest rates, certainly they're rising. This chart is a little out of date. I would say we're closer to 6 to 7%, but not historically high. Michael mentioned this. We're back to what we were in 2009, and nothing like what we were in the 1980s. Certainly higher than we were 2 years ago. So it feels high, but historically not that high. The next slide really gets into where this interest expense has an impact. Those double-digit interest rates of 1980. This chart shows the blue line is debt, the red line is interest expense, what you were writing the check for. And they were pretty comparable back in 1980. They're not today because interest rates are half or less of what they were at that time. So that's really a positive factor when you think about the overall farm income picture. Here's debt to equity and debt to asset ratios. Our asset values are 2 and 3 times, 4 times what they were in 1980, maybe even 5. And so as a result, when you put the same amount of debt on a much higher asset value, you get very low solvency ratios. And then here's another ratio to watch. And this is income divided into debt. So let's say you got $1 million of debt and you make $250,000 on your farm. That's a debt to income ratio of 4 to 1. The most economists would say 5.5 and above is concerning. Now this chart's a little blurry, but if you go back to 1976, that's when that started to move above 5.5. And that should have been a warning indicator back at that time, that once it got well above that, we were in trouble. Today we're at 3.1. We were above 5.5 in 2016, but then due to federal subsidies and farm incomes improving, we've gone well below that number today. So that's not really a concern either. And this reflects it pretty well in farm loan repayment rates, well above 100. That's a positive. They're paying back early. And then you've got farm real estate loans that are delinquent and well below normal as well. So really from a debt standpoint, I think the ag industry is in a pretty good spot. So where do land values go from here? It really depends on farm incomes, interest rates, and supply. Michael said inflation would be another factor in this, but he pointed out there are a lot of different factors in farmland values, but these are the main 3. Incomes from 2007 to 2013 generated tons of cash. That's why 2013 was the previous all-time high. Then we saw farm incomes decline and cash kind of drain out of the ag economy. Government support became absolutely critical from 2018 to 2020. This was your market facilitation payments followed by COVID payments. Had we not had that, and I'll show you a couple of charts here in a second, that income decline would have extended into 19, 20, and maybe even 21. Interest rates are increasing rapidly. And then farms for sale are more of a typical 2%, but that's not overburdensome today. That's the supply factor in all of this. So USDA farm incomes, all-time record, $187 billion. So when you think about the liquidity, Michael mentioned that on the one slide as being a significant factor. This is something at Top Farmer that was discussed. There's just a lot of cash out there. Cash from COVID payments, cash from the subsidy programs and support programs a couple of years ago, and then really 2 good farm income years. And so if I'm a farmer and I have some excess cash and I can't buy equipment because it just doesn't exist, or I think it's super high priced, if the 80 acres next to me comes up for sale, you're probably going to buy it. And that's where that liquidity becomes a factor. And that's been real positive the last 2 years of incomes. Here's another way to look at incomes that I would suggest to you going forward. How do you measure a farm income projection? From 1973 to 2007, think ethanol and Chinese demand then, $85 billion was a good number. Above that, it was a good year. Below that, maybe not. That has all changed. Now it's 115 billion. So when you get 160 or 187, depending on which net farm income number you like, you're well above that number. So going forward, when we think about 23 and USDA starts to publish income numbers, keep in mind that 115 billion is kind of the target that you're wanting to be above. Michael talked about cash rent expectations being stronger. AEI did this back in June, July, and August. It showed weakness across that time period. Now, all of these are expectations that rents were going to go up. Michael mentioned that big number out of Illinois, $600 an acre. I think that was on AgWeb that I read it. It was a cash rent auction. Halderman does not do cash rent auctions. I want to be real clear with that. We might do sealed bids from time to time, but we do not do auctions for a whole host of reasons that we don't need to get into here. But certainly the market is stronger for 23 rents. And they have kind of lagged farm value increases the last couple of years, but the rents are moving up for 23. And I don't think that would be a surprise to anybody based on the incomes that we had. Income of USDA, impact of USDA payments. These are inflation adjusted payments. Look at 2020, all-time high inflation adjusted payments, including PIC years back in the 1980s and all of that. Here's what would have happened to farm incomes had we not had those payments. Now, I didn't show 21 or 22 because that starts to change because of commodity price increases, but we would have been in pretty tough straits in 2020, early 21, had we not had those support payments. Michael mentioned the impacts of renewable diesel. This really shows it. Here's the price of soybean oil. Most of my career, soybeans were all about the meal, the feed aspect, not so much about the oil. It's almost a byproduct. And look at the way that price has jumped. And that's all due to the renewable diesel demand. And if we move, and some people have said, if you moved all of the airline fleet over to renewable diesel, I think it would take all the soybeans we produce. Odds of that happening are slim because that's going to skew the market way too high. Be great for farmers, right? Don't count on it, but it is a demand driver. And then impact of trade. I just think this is kind of a cool slide when you think about the phase one of the trade agreement with China. We went from $28 billion of trade to $36 billion due to that phase one trade agreement. What was interesting to me is what were really impactful: corn and beef. Those are the bigger green bars. Soybeans, not so much. So I found that interesting that the biggest jump was due to corn. And then Michael talked about the increase in fertilizer prices. Don't need to really discuss that. That is certainly an impact and kind of a negative override on the whole ag economy. Timber values, they have been up. I haven't gotten the 23 report yet. You might expect timber values to come off a little bit. Certainly Indiana's a hardwood timber producer, and as housing goes, so go timber prices. I mentioned cap rate earlier. Cap rate is your income divided by the value of the farm. And rents did not go up as much as land values did. So cap rates came down, and they're in the low 2s today. Now, for the farm that's adjoining you, farmers tend to accept a lower rate of return on that because you do a portfolio approach when you rent farms and own land. Investors don't. So investors, institutional investors, if they want a 3.5% return, that's not the market today. So that's my comment earlier that we really aren't seeing a lot of institutional money come into farmland because the cap rate's too low. Something worth watching. So farmland is worth what it earns. I'm going to cover these real quick. These are cash rent survey results from my staff. I did this back in September, so it's a little dated, but I think it's still applicable because basically it says, yes, we were seeing more demand for land to rent, not any supply. And so rents were going up and we were expecting cash rents to increase. Did we have any tenants in distress? Yes, we had one that was still in a little bit of distress. So there are some instances where there are some struggles out there. Now we utilize a lot of cash flex leases. So you've got a guaranteed rent and then you have potential for upside if it's a good year. There were some big bonus payments paid to our landowners last December because 2022 was a really good income year. It's based on gross revenue, not price, not yield, but both. And we had some really nice gross revenues. So we continue to use a lot of cash flex leases at Halderman. Base gross revenues went up last year. They'll be up again in 23 because costs of production are up. So the way this would work is you're going to have a guaranteed base gross rent, let's say $300 an acre, half in the spring, half in the fall. And then if corn revenues are above $1,050 an acre, so let's say $1,200 an acre, maybe the landowner gets a third of every dollar over $10.50. That's the way that metric works. A lot of different negotiated items there and a lot of different calculations. Chris and Lauren can help you with that if you have questions. I just bring it up briefly to point out that it's a way we mitigate some risk for the tenant on the front end, but it gives upside potential to the landowner with a very objective way to calculate the bonus. Now, I mentioned earlier, rents didn't jump as much as farmland values. If you recall the farmland value chart, there was a big hockey stick move up to the right, and we don't see quite that big a move up. They were up, but not as quickly as farmland values, and therefore cap rates came down. So we'll get into the forecast and wrap my portion up. Keep in mind, you have long-term world demand fundamentals. Michael mentioned this. It's bullish for agriculture long-term and therefore land prices. We've got to produce more food. Just-in-time delivery impacts. Boy, this comes home to roost this week, doesn't it? It rains in Argentina and our corn and soybean prices are down Monday significantly. It doesn't rain in Argentina and they jump up. You know, Argentina is not even not anywhere close to it's a third of the production or less of Brazil. Yet they are big enough that they have a material impact in the marketplace today. So when I talk about just-in-time delivery impacts, that's an example of it. Interest rates are up 2%, 2 percentage points from the lowest ever, just 2 years ago. Supply of farms for sale are picked up last fall. They remain near normal. I would not plan on a lot of government support. There wasn't a lot last year. There probably won't be a lot this year. Talking about the farm bill, this is a farm bill year. Some experts I heard a couple of weeks ago at the Farm Foundation meeting would tell you, don't expect it until 2024. So probably we'll get a renewal, an extension of the current farm bill for another year. Most folks figure that crop insurance and ARC and PLC in some fashion will continue on in the new farm bill. So I wouldn't look for a lot of change there, but odds are you won't see it until 24 anyway. And then of course you got the inflation factors Michael talked about, increases in the break evens. So then as we look at record incomes and generating more cash, you know, how does this all spill out into farmland values? We're certainly in an uptrend with cropland values. I agree with Michael. I would not expect a 20% increase this year, but could we see another 5%? Maybe so. And based upon the 3 sales we've had so far this year, the market's not going down. Other parts of the rural market, the rural landscape though, I would be a little more questionable on what they do. And so I put these as steady to weaker. Timber, recreational land, rural residential. The Hassel Farm, watch those. That's 80 acres and 5 fields. I'm not hammering on Randolph County at all, but there are some fields like that out there in Randolph County because I know in Wabash County where I live, we have some of those. There's a bigger spread between best quality or most efficient farm and not so efficient farm. So if you've got that kind of farm, you want to sell it, don't expect $15,000 an acre today, unless you can subdivide it. So where do we go from here? I'm bullish. I've already told you where I expect farmland values to go, and it's for these reasons. We've got cash, we've got liquidity due to profitable prices. You got a low amount of debt to assets in agriculture, moderate supply of farms for sale. The RFS for this year and the next year have already come out and they're neutral. They're not a change negatively, not a change upward, just neutral. Population growth, trade deals, inflation, those are all positive factors in the farm marketplace. The bearish factors, so these are things to watch. I can be bearish on farmland values if you tell me we're looking at 450 corn in the fall. And if you look at what Brazil's producing right now, and then you have US produce a good crop this year, which is totally unknown in January. But if that happens, with the kind of tepid demand that we see out there, yeah, could we see $5 corn, which would be below break even? You could. So you combine that with higher interest rates, and one might be able to argue a 10% decline in farmland values. But that's not where we are today. You can sell the 23 crop at profitable levels. You can sell you have sold or can sell the remainder of your 22 crop at profitable levels. So I'm not arguing for down market. I'm just saying the potential exists if those dynamics happen. And oh, by the way, back in 2014 and 15, when we saw crop prices drop, we saw a 15%, 20% decline in land values. That's not horrible. That would be a normal correction in a marketplace. So other assets, alternative investments. When CD rates are 3.5 or 4%, that might encourage people to invest in CDs or bonds instead of farmland, which is returning 2%. So that's how that factors into that. We don't have a lot of working capital concerns today. Honestly, the bullish fundamentals are carrying the market as we speak here in January, and we're calling the market steady to up 5%. And then I asked our group back in September, where do you project values to between then and March? And you can see we were positive on farmland and a little less so on rural residential lots and recreational. So that leads me to the end and questions. So what questions do you have either in the room or via the chat? And I will stop sharing. I don't see anything in the chat yet. Amy, do you have any questions there in the room?
Does have any questions?
Any questions for Howard?
Well, I think it'll be interesting to watch renewables, solar and wind. I think Randolph County has been impacted by both. How we do electricity in the future is changing. How we do energy probably is a better statement. So as you start to think about it going forward, I was with an engineer at Cummins back in August at a football game. His son and my son play together at Taylor University. And he made the comment, Cummins was looking heavily at hydrogen. So before you think EVs are the final answer on how we do energy in the future, not so fast. So markets will settle themselves out. And I don't know that it'll all be electric. It'll all be petroleum based. So I think as you watch those dynamics, it'll be very interesting to watch. But there are opportunities, right? If you can lease your land for $1,000, $1,200 an acre for solar, maybe that's something you want to consider for 50 or 60 acres of your farm. So that whole market's rapidly very dynamic and changing. Something to watch as you go forward. But if there aren't any questions, Amy, I will turn it back to you, and you can turn it over to Zoe.
Howard, we're going to have we do have a question. David?
Oh, yes.
How does a wind turbine on farm ground affect the price?
Did you hear
So
that?
I did.
Okay.
Great question. So first of all, I'll mention solar. There aren't any solar leases that are really in place and operational today to tell you what the impact on farmland values will be there. But on wind, there are plenty of wind farms around the state, and we find them to be positive to farmland values. It's capitalizing an income stream. You're taking a half an acre out of production, maybe more or less, depending on the road and other things. But you're taking half an acre out of production. We find on 80 acres, 80 to 160 acres, if you have one turbine, that could add anywhere from $500 to $1,000 an acre in additional value because of the additional income that returns to the landowner with no charge for that income. So that's what we've seen so far in the marketplace.
Anybody else? Okay, no other questions at this time. So
okay, well, thank you all.
Are you gonna?
We appreciate it. I'll hang on the call, and if you got other questions, put them in the chat room, and be glad to answer them.
Okay, thank you. All right, we're gonna transition over here to Zoe. I got it. We're going to turn this down. I'll introduce you here in a second. Excuse me, stuck. Well, where'd they go?
So you might keep in mind too, this is all being recorded, hopefully with technology. But if anybody would like to copy this afterwards, just let me know and we'll get that to you. Sometimes it takes a day or two before I receive that, but if you like a copy of this, just let me know and we'll send you the link.
Kara. Sorry. Oh, it's good. Okay, it's doing what it's, okay, looking at the wrong thing. Okay. Alrighty, so we're gonna finish up the day with Zoe Robinson. She is the Health and Human Science educator here in Randolph County. You've been here about a year and a half?
Yeah.
Year and a half, okay. So she should look familiar to you. Zoe did 10 years in 4-H. She's a former FFA member of mine. And so she's also been, even though she's a health and human science educator, she's been involved with agriculture and also has a passion for agriculture. So I'm gonna let her take over the next section.
Right. Well, thank you, Amy and Aldermans, for having me today. So today I'm going to talk to you guys about weathering the storm in agriculture. So it's a lot of talking about mental health and stress that does come with being in agriculture. So just a little bit more about me. Like Amy said, I am the Health and Human Sciences educator. I graduated from Purdue in May of 2021, and my degree was in animal science and ag business. So deep ties to agriculture, and I grew up in it, grew up showing livestock, and it's kind of carrying over into my nieces and nephews, their lifestyle as well. So I am on the Purdue Extension Farm Stress Team. So we work with farmers, farm families, and agribusinesses on how to handle stress and maybe certain situations that you may feel difficult or your mental health could be affected. So I know a lot of you work on farms. So show of hands, who works with family? A lot of us, yeah. Okay, so I saw quite a few hands. So I'm gonna call on Lauren and Chris and Carla. So could you tell me just what it's like working with family? Just give us some couple words to describe it. Okay, I heard stressful here. Amazing. Compromise. Yep. It can be entertaining. Yeah. So the thing that pointed or kind of stuck out to me is that stressful, right? So we might have those stressors in life, and working with family, it can get a little cloudy sometimes. You do have that stress that goes along with it. And working in agriculture, it can be a very stressful occupation, right? So there are many factors that might work against you. Like today, if you're a livestock producer, you might have a little more stress than usual, right? If you look out the window, we can tell that. So it's a very stressful, and there's a lot of unknowns in agriculture, things that are out of our control. So we're just gonna dive in a little more about stress. So what is stress? It's a need or demand people confront that is perceived as a burden or threatening and can lead to physical or mental health problems. So it could affect your body as well as mental capacity as well. So being able that might cloud your decision making. or you might get angry at some of that family that you work with, and you might spout off and you may say things that you don't mean. And it can kind of, stress can really cloud our judgment during stressful times. So here are just some signs of stress, which I want you guys to think about yourselves during this presentation, but also maybe coworkers and family and friends as well. So some of those are to our body. They might be headaches, stomach aches, back aches, high blood pressure, high blood sugar, racing heart, and nausea. So a lot of us carry stress in different ways. Some carry it in their neck. You can really feel it affect your body. I carry my stress in my stomach. I get very worked up and I feel anxious and my stomach hurts. So we all have those different ways that stress can affect our bodies. Right along with your body, your mind can maybe feel anxious, angry, sad, bitter, depressed, or hopeless whenever you have those feelings of stress. And this can ultimately affect our actions as well. So you're not getting enough sleep. Maybe you're sleeping too much, not getting tasks done each day. You don't eat. Maybe you're overeating. Increased use of cigarettes, drugs, alcohol. You might break things, yell, scream, and just withdraw. So maybe you notice somebody's not going to Wix as much in the morning for breakfast, and you kind of start noticing that. They could be maybe facing more times of stress as well. So just watching out for each other as well, checking in and just seeing how people are is very important. So understanding our root causes of stress. So you all are in agriculture. So what are some things that affect agriculture that could be stressful? Just yell them out for me.
Why?
What did you say? The wife? Maybe it's the wife. What else? Weather, yep, definitely. Input costs, yep. Seasons, for sure. All right, so those are all great factors, and a lot of them that you listed are up here. The wife, I mean, that's disagreements with family members. She could be in there, you know. So just some factors that come into agriculture, and so many of these are out of our control, and we're not able to change the weather. So like today, we have no control over the snow that we're getting. So many factors that are affecting our stress, they're out of our control completely. So some of those include weather, large debt loads, government regulations, machinery breakdown, high interest rates, crop yield, livestock illness, commodity prices, and disagreements with family members, maybe your wife, maybe she's fitting right in there. So all of these can affect your stress level, and ultimately are going to affect your actions and your work. So I forgot my jars in my office, but so as you can see from these jars, we have one that is perfectly clear. So that is your mind when you're completely stress-free. You don't have any stress on your mind. You're just chugging along. Everything's great. Yields are great. Livestock are all healthy. But then you have the jar that's a little more cloudy. So you have maybe your wife is angry at you. Maybe your kids are just going from basketball practice to maybe their show pigs are sick in the barn and you don't know what's going on. You just have a lot going on. It keeps raining, but then it gets really dry. So you just have a lot of factors. So your brain is going to produce cortisol. So this affects your mind and your decision making ultimately. So it clouds your judgment. Like our jar, the darker jar, that's more clouding your decision making, your mind, and your clarity. So you're going to be feeling a little more heavy with stress. So along with stress, you have to be able to cope with that. So being able to really come up with strategies that work for you. So maybe it's, you just maybe need to take a drive and listen to music. Just finding those ways to get out of your head and maybe let that stress go a little bit. So adding those to your toolbox are super important during stressful times. So some key points about having all of those tools in your toolbox would be, think about the ways that you can manage stress. So what are some ways you guys manage stress? Do you yell? Does that help you to get out your stress? Write it down. Maybe if you just have a mile-long list of things to do in your mind, does it help to just write it all down and check it off? We might eat, yeah, have some time. So we might have those different strategies for managing our stress. So we need to think about matching the strategy you will use to a particular need. So brainstorm and explore a variety of coping strategies that are available, and then learning new strategies or adapting different ways of managing stress that may not be used before, but may be necessary for you. So I'll use, like when I feel stressed, I just need to get outside. I like to go, my nieces and nephews show livestock, so going out to their show barn to look at their pigs or goats or whatever they have in the barn, being able to interact with them and just get out in nature is what really gets me out of my head and get away for a while. So we might have different ways of coping with stress, and it just depends on what you enjoy. So here are 3 strategies. The program that I use is for Michigan State University. So these are some things that they suggest doing. So self-talk. So our mind can really play games with us sometimes, right? Our thoughts are very powerful. So we need to be careful how we're talking to ourselves. So you may just talk yourself down and say, oh, I can't do that. I'm not going to try that today. I've done enough. But just make sure that your thoughts are positive as well. And how you respond to those thoughts, you might feel like you have no control. Do you manage them? Do you just avoid them? Just say, oh, it's fine. Do you point blame? Maybe it's someone at your operation said, I wasn't able to do that because of him. So whenever you have that self-doubt in your mind, I want you guys to kind of think of 3 words that will help ease your mind and have more thought and purpose to overcoming what challenges you might have. So just in your mind, think of 3 words that would just keep you going. So maybe it's being calm. Say you're capable, or I do have control. So just turn into those words whenever you might be feeling self-doubt or just down on yourself. Those 3 words of positivity and being able to turn to those in times of need. Another strategy is just breathing. So staying calm whenever maybe you're working on the tractor and then you need to move to work on the combine. Just taking those seconds while you walk in between. Just take deep breaths, and that can help reduce the amount of cortisol that's moving through your brain if you do feel stressed, and that will help reduce that pain and maybe even improve your sleep as well. And the last one is use acceptance. So if you don't like something, you can change. You might not be able to change it, but maybe you can. And it's maybe a mindset thing. Just changing your attitude about it. Say, I may not be able to do this task that I used to, but I'm going to try it this way and make sure I can handle it this way. So just being accepting and saying, this might be out of my control completely. I may not be able to fix this. So just having that mindset as well. So this one, have you guys ever heard the term, I have a lot on my plate right now. I don't know if I can take on anything else. I'm just pretty weighed down. So this next one, since we're all kind of groggy, we're kind of full from lunch. I'm gonna have you guys do an interactive activity, and Amy, I might need your help with this. So you all are going to receive a plate. All right, so Amy's gonna give you all a plate, and you guys are going to write down what's on your plate. So what stresses you might be having, or so like for this one, for example, you're stressed about your kids, you're stressed about money, maybe it's stress at work, the weather, your livestock, and then crop storage. So go ahead and write down, I'll give you guys a couple minutes here, write down some stress that you might be having in your life.
Thank you.
And if nobody has anything on their plate, I want to hear how you guys are stress free. So we can get some tips. Because I don't know how you do it. All right, I'll give you guys a couple minutes here. Write down your stress on your plate. Okay, so now that you guys have had some time to think, so yell out some of those stress that you might be having. Anything.
Generator not reliable.
Generator is not reliable.
Oh, 1099.
All 1099s are due by January 31st.
I thought you retired, Bob.
Garrett, what stress do you have?
He's got nothing on his plate.
So Garrett, how do you stay stress free? What's your, mom takes care of you?
No, I don't.
All right, so now that we have our stressors on our plate, I want you guys to now look at those and say, or circle which ones you have no control of. So there's nothing you can do that's going to affect that. So were there any that you guys can't control? Were you able to control?
Up back here.
What?
Matt is feeling beat up back here on interest rate.
You hear a lot of talk about interest rate being a big concern, and it is. I understand that they interested. But historically, we are still below average, and we really haven't seen the effects of higher interest rates yet. You know, most people are just renewing now, so it's definitely something to watch. But I don't think we should blame anything on interest rates.
All right, so do you have strengths that you can't control? You're like, yeah, yeah. 401k, yeah. So we might have stress that is completely out of our control, right? So maybe there are some stress on your plate that you could say, maybe my time and energy is not worth thinking about that. I know our office manager, Sue, she has something like a daily reminder that says, if it's not going to affect you in 5 years, why worry 5 minutes about it? So kind of think about that. If there's anything that you're not able to control, is it worth the time and energy to stress yourself out or worry about that? So that we just wanted to get you guys thinking and do a little hands-on activity since we just got lunch. We're kind of sleepy. So this presentation is really about looking out for yourselves and just focusing on your stress and how you might be affected as well. But you can also look out for someone else. So maybe it's a family member, people you work with, just being able to be there for somebody and you can really make somebody's day by just checking on them, see how they're doing. Maybe if they are stressed, you might be able to help them out by just letting them talk. So on another note, stress can also lead to more serious factors. I know Randolph County, we have been affected by suicide in the last couple months. So just want to plug in these warning signs as well, just because the agriculture community, I mean, Randolph County, we're all very close-knit community, so a lot of us know what's going on, and we may not know everything that's going on in someone's life. So just some warning signs of suicide, just because we need to watch out for each other. You never know what could be going on in someone's life. So maybe some warning signs of suicide that could be talking or writing about suicide or death, feeling hopeless, trapped, or you're just a burden. Maybe you're a burden to the family operation. Giving away prized possessions or selling equipment or land or something along those lines. Making a plan or acquiring means. You may be saying goodbyes to people. Isolation from others. So like I said, you may not notice people going to have coffee in the morning, or that you normally do. So that could be affecting them as well. And just a loss of interest as well as mood change. So I'm not saying that everybody who might be having a down day, they're not having these thoughts, but you just never know what someone's mental state might be. So just being able to check in and be there for them as well. And then some people, they just want to tiptoe around the subject of suicide completely. And if you know of anyone who is ever having thoughts of this, we just need to ask them directly. Just come out and ask, are you having thoughts of suicide? Asking directly does not increase the risk of suicide, and it may also provide a comfort to someone who may be having those thoughts. So it'll be a relief to them that someone is checking in on them and someone is worried about them. So just don't be afraid to be direct. And if they were to say yes, and you're sitting right there with them, do not leave them alone, and then call for help and help from the hospital. Oh, no, there we go. Take them to the hospital or any healthcare providers. So just wanted to have those resources out just because our community has been affected by that, and just knowing signs and how to handle that in situations. And there's also the National Suicide Prevention Lifeline. You could call that as well, or give that to someone if you know they might be having some mental health issues as well. Those are more. So some of our state resources we have for rural services of Indiana, that I have that phone number, and then Be Well Crisis Helpline of Indiana. So you give that a call, enter your zip code and press 3. And some of our local resources, if you ever need anything, you can contact the Randolph County Extension Office. I have a plethora of different resources discussing mental health in the agriculture community, and Amy does too through Purdue. So we're able to help in any way we can. And Centerstone Crisis Hotline and Meridian Health Services. And then some other plugs here for the Farm Stress team. We have a podcast. It's called Tools for Today's Farmers. So I help host that as well. So that's available on iTunes, Spotify, anywhere that you can look up your podcast. So we just have a variety of different people in the agricultural community that we interview just to share their stories. And then our farm women, so maybe you guys could send this to your wives or your moms or anyone, any ladies in your life. The Farm Stress team, we're working on sending out this survey to women in agriculture. We just want to see how we can better serve them in the communities as well. So just being able to reach all of our audiences out there. So you guys can share that as well. And then just to wrap it up, so my biggest take home for you guys today is just don't be afraid to talk about how you're feeling if you are experiencing stress, and reaching out to people and just checking in on each other. That's the biggest support you can have in surrounding yourselves with those people who are willing to listen, or just finding resources that you can take further. And so there's a lot in Randolph County and the agriculture community. So letting each other know that we're all here is very important. And then our extension office phone number and my email are there if you guys need any resources or anything, or need to talk to Amy or I about anything. So, or Julie with our 4-H, you got kids. Maybe you're stressed about signing your kids up for 4-H. We can take care of that today. We can help you today. So, Amy passed out some surveys for you guys. If you don't mind filling out the green one, it's the Farm Stress one. It's a front and back sheet. And then Amy passed out an orange survey as well. So that is all I have. Thank you for having me.
Does anybody have any questions for Zoe on the topic that she covered? I know for us in the office, since she's become a part of the Farm Stress team, we've been doing some of the suggested activities and come up with a few of our own. So one of them is we start each day, we have a notebook, and we start each day with the 3 things that we're grateful for that has in the last 24 hours. So we start the day off in a positive mindset, and let me tell you, that does make a huge difference. And then before we go home, no matter what time of day we had, we write down 1 positive. It's 3 gratefuls, 1 positive, right? Something like that. So before we leave, then we say something that we're grateful for that happened during the day. So like this morning, I know Isaac Thornburg just volunteered his time and came up here and cleaned out the parking lot for everybody coming in. So I was grateful for that. So you start your work day with a positive, you end it with a positive, and you start positive before you head home. So that's some things that we do. We practice a lot of this stuff to see if it really works before we, preach this stuff. So it does work for us. So appreciate everybody coming today. And I think the Halderman Farm Management Group from Winchester have been awesome to work with, and providing lunch for us. That was yummy, yummy. I think we need to partner a lot more often and get lunch from Ruth. It was really good. So if you have, this was recorded today. So if you'd like to watch it again, or somebody that you know, that's fine as well. So our office is always open. So if you'll take a minute and fill out those papers, I know it's a hassle. It's voluntary, but we so much appreciate it, because that's how Purdue knows we haven't been outside making snowmen today.
Yeah.
So thank you very much.